Hi, everyone. I'm Bill Squadron, President of Our Energy Policy, and welcome to our webinar today on the state of energy finance. We're delighted to be joined by an expert panel and moderator, which we'll be getting to in just a minute. First of all, I would very much like to thank our partners for supporting our OEP Energy Leaders webinar series, API, Bracewell, Broadscale, the Grace Richardson Fund, Shepherd Mullen, US Grid, Schiff Harden, EPSA, Eastern Generation, National Grid, the J.M. Kaplan Fund, Con Edison, and the Clean Fight New York, and particularly my co-host today, Citi. And I would particularly like to direct your attention to something we'll be posting in just a moment in the chat section of your screen, which will be a link to the Our Energy Library, where we have posted a recent report prepared by Citi on financing a greener planet. And it's an excellent, recently released comprehensive analysis of this space. And there are other resources, as many of you know and use through the Our Energy Library, but really highly recommend this, and of course recommend that you use the library for all the work you're doing, since the resources there, studies, reports, papers, and so forth, is the most comprehensive energy resource online. So we will be getting to our group in just a second. The other thing I'd like to remind everyone of is that if you have questions, which we'll be getting to in the second part of the hour, please type them in the questions tab on the right side of your screen in that dashboard, and we'll get to as many questions as we possibly can. So once again, thanks to my co-host Citi for this. I'm now going to turn this over to Ed Morse, our moderator. Ed is the Global Head of Commodities Research at Citi, which he's headed since 2011, having previously built similar groups both at Lehman and Credit Suisse, covering the full panoply of financially traded commodities. He's taught at Princeton, Columbia, and Johns Hopkins. He's worked as a senior fellow at the Council of Foreign Relations. He's been the Deputy Assistant Secretary of State for Energy Policy. He brings a wealth of experience and perspective to this discussion, and we're delighted to have him here to moderate for us. Ed, take it over.
Thanks very much. It's a pleasure to be with you. It's a pleasure to co-host. We had recently, as Bill noted, published a report called Financing a Greener Planet. We try to take an assessment of where we were. We think the world is at a turning point. It's a fragile turning point in terms of getting to the Paris goals or something even better. But it was really remarkable last year, in fact, during the pandemic year. If we look at the estimated $3 to $5 trillion needed to meet those goals, just in sustainability bonds alone, a very little bit of it, $2 billion worth, may be greenwashing, but of that 552 billion that was done last year, that was an increase of 75% from the year before. And altogether, there was clearly over $1 trillion invested, not 3, not 5, whatever those numbers might mean. I'd like to point out that this year started with a bang. First quarter sustainability bond issuance around the world was around 262 billion US dollars. That compares to 99 billion in the first quarter of last year. And if it just stays even, although it tends to go up quarter by quarter, that would mean on sustainability bonds alone, it would be over $1 trillion in 2021. A long way to go still. With me on the panel today, and I hope you get on with your picture so we can all see everybody, are 3 people, 2 of whom I've known for a very long time. John Goldberg is the founder and CEO of Carbon Direct. It's an effort to bring together people from who are technically savvy on carbon removal issues, together with people in the financial community, to see to it that the financing is done for a greener planet. Before launching Carbon Direct, he had his own fund, BBL Commodities. It was a commodity hedge fund where he and I interacted a lot. We interact a lot as members, co-members of the Columbia University Center on Global Energy Policy. Before John founded that, he was at J. Aron in the commodities division as a proprietary trader. Next alphabetically, on the lower right is my colleague at Citi, Catherine Mann. Catherine is the chief global economist, global chief economist at Citi, where she's responsible for thought leadership, research guidance of a global team of economists, and cross-fertilization of research across macroeconomics, fixed income, and equities. Before she came to Citi, she had been the chief economist of the OECD, and she spent more than 2 decades in Washington with such organizations as the P. Peterson Institute on International Economics, the International Finance Division of the Federal Reserve Bank, Federal Reserve Board of Governors, and the President's Council of Economic Advisors in the World Bank. And like me, she started life as an academic, was a professor at Brandeis University. Finally, joining us is Inosa Nyata. She's a lawyer, a partner in Sullivan and Cromwell's New York office, where she heads up the global project development and finance practice. She advises a cross-section of clients in renewables in particular, so she's got a lot of expertise in project finance on the renewable side, an area that is exploding in terms of global practices. And she's also involved in other energy sectors on a range of financial transactions, including a variety of types of debt financing and equity investments. And she's been involved extensively in advising on innovative and first of their kind structures for use by energy projects in order to achieve bankability from a range of sources. And she and I have had an offline conversation recently on one of those areas, which has been financing of reforestation, afforestation, something that is very big in the subject matter that we are going to be addressing today, but where financial mechanisms are lagging, and where greenwashing is particularly prominent, and where there is just this risk that you invest and get carbon credits and making forests, and then climate change burdens them down. Anyway, it's a pleasure to be with you. We're going to be kind of interacting, asking a lot of questions. Inosa, I'm going to start with you. Our current report states that we have to close the clean energy investment gap between what's currently being spent, as I mentioned, maybe $1 trillion US last year, and what needs to be spent in order to meet the Paris Climate Accord goals. Some think this gap may be as high, or the needs may be as high as 3 to 5 trillion. What are your thoughts on the current state of energy finance, and how do we close the gap?
Thanks, Ed. So I'll let Jonathan and Catherine talk about it from a policy perspective. As you said, I come to it from a transactional perspective. I'm a deal lawyer. What matters from my perspective is, no matter what the policy is, how do we help our clients get deals actually done? As you've said, and you indicated from the Citi report, there's a huge amount of capital that's required. And it's expected and anticipated that a big chunk of this capital will need to come from private sector sources. And so these are the developers, the producers, suppliers, private capital and lenders. And how do they do this? How do they get comfortable putting capital in for these really long-lived assets? So you're not thinking about a short-term investment return, you're really looking at it from a 25+ year perspective. And so here, in terms of the way we think about it from a deal lawyer perspective, and we do this a lot with first of kind developments, not just in the sector like new energy, but in countries that haven't had development before, is to think about the framework, the commercial framework, the permitting framework, the incentive framework. Is that certain? Is it stable? And is it durable for these long-lived assets? And as you've mentioned, Ed, we've seen, particularly over the past year, this big buildup of capital sources, right? ESG funds, private equity funds that are being formed, energy infra funds. Every day you look in the paper, there's a new fund being created, there's a new initiative. We just saw Coke and Exxon, announce carbon capture initiatives. So how does that get translated into actual spending of that money to develop the projects? And it goes back to the certainty, stability, and durability. And I think offshore wind in the US is a good example. Right? We had the Block Island, which is 30 megawatts. It's a small operational facility, and we're looking to ramp that up into 800, 2,400 megawatt wind farms off the eastern coast with huge players, Avangrid, Eversource, BP, Equinor, already putting in equity capital to spend and needing significant amount of additional capital, both for debt and tax equity. And we've seen that start to happen, right? The focus is on commercial arrangements, right? Who is the off-taker? And the states on the east that are supporting, eastern shore of the US that are supporting these projects have been sort of quite helpful in setting these up, right? We have New York, New Jersey, and Maryland setting up OREC contracts with renewable energy credits. Massachusetts, Rhode Island have a utility model. Virginia also has a utility model. And they have developed these PPAs that are bankable and that people are looking at as a strong basis to support offshore wind.
Yeah.
Permitting is another.
Just in short, and since we need to get on to a lot of other questions, but just in short, what are your estimates on? Are you optimistic about the gap being closed? Are you seeing things in momentum building up, or are there problems ahead?
I think in offshore wind, the gap, we are anticipating the gap will be closed. You know, I think permitting has had some issues up and down. Those who know the Vineyard Wind story have seen that happen, but the Biden administration is supportive. Tax credits have been clarified. There's now a clear regime for tax credits for offshore wind. So that's an example where I think the pieces are falling into place where this capital can be deployed to really support a big explosion of all the projects that are in the pipeline.
Thanks a lot. John, just following up on that, since Carbon Direct, your company, is working with many companies directly that have made some pledges, what insights can you bring to what's happening and not happening in terms of closing that gap?
Yeah, no, thanks, Ed. Unfortunately, I would say there are definitely exceptions, but there's more not happening than happening. It's much easier to make a pledge to be carbon neutral or carbon negative by some faraway date than to do it. We are encouraged that, recently we're seeing an uptick of folks, large corporates who are taking this very seriously, are implementing plans, are either are doing some combination of working on lowering the overall supply chain CO2 intensity and or focusing on carbon removal credits of some form to get rid of the amount of CO2 that they can't ultimately reduce from their own supply chain emissions. However, this is a process, and I think we're kind of past the first phase of corporates making large-scale announcements, and we're very early in the phase of making those plans tangible. There's a range of progress depending on who the client is, which sector it's in, but there's a long way to go. And there's also not a great supply chain yet of actual carbon solutions. You had mentioned the reforestation carbon credit example. There simply aren't a lot of high quality carbon credits out there for corporates to buy. So we really need to build the demand in the supply chain in this world.
Yeah, we'll get back to that in a few minutes, but the private sector is responding. It's responding more directly than it had been, but it's just not quite there yet. On the public side, Catherine, climate change risks have recently caught the attention of central banks and other international financial institutions. What role do central banks and regulators play in helping to get to the carbon goal line, and what challenges they confront? And we'll get back to you to complete whatever observations you have, but
right. Yeah, I mean, I think it's important to note from the previous two speakers the intersection of market incentives and public policy. Because, in the end, it is the private sector that's going to have to do the heavy lifting here. There is not enough government money around to finance what needs to be done in order to get to the carbon goal line. So we have to talk about the intersection of market incentives and the public policies that help move those market incentives along. Market incentives come from customers wanting to know about their carbon footprint of the product. The investors want the bonds. The borrowers want to do the loans. So the backdrop to that, though, should be carbon pricing. We're not there yet. It's a very difficult challenge. And so central banks and regulators have taken on the responsibility of total climate finance disclosure, which is voluntary. It's not a requirement, that private financial institutions prepare on their balance sheet the exposure of their balance sheet to carbon, as well as a couple of other things in the ESG framework. But the principal one is carbon. And the point is, if there were that type of disclosure on the balance sheets of the private financial institutions, that would percolate down to incentivize the lending or the deal making for more climate-friendly capital allocation by firms. That's a big channel of transmission, but it is an important incentive that works to complement what, as I say, are already market incentives in there having to do with customers, investors, and borrowers. It's not the only tool, but it's an important one.
Well, thanks. And we'll get back to some of the issues of transparency as we go on in the conversation.
Right.
But you talked about this, and John, what have you seen in terms of federal and state policies, if any, and which ones do you support in order to incentivize investment in clean energy projects? And we've talked both offline and elsewhere on tax code inducements like 45Q. Are these worth pursuing, and can we be building on them?
Yeah, and I totally agree. You need a combination of policy support combined with private sector action to make any of this work. I think 45Q is a great example, and just I'm sure the audience is aware, but it's the background and also the recent expansion of 45Q to pay now $50 in a direct payment method for the capture of CO2 at the point of emission. So for point source carbon capture, extending that has been a really, really big boon to point source capture companies. You're seeing.
So just to interrupt for a second, Catherine had mentioned the importance of carbon pricing, and in the U.S. we haven't been able to do it. But is it not a backdoor way of getting there?
That's it. For the producers, yes, but you also have to have the incentives facing consumers.
Yeah, so 45Q, and then on the state level, things like the low carbon fuel standard in California, which is spreading to many other states, is a backdoor or a subtle form of pricing. Now, globally, you are seeing more pricing, right? The Canadian budget calls for an increase up to $130. You're seeing that in Europe in some cases as well. And these are all, and EU ETS doing this in a different form. These are all indirectly supporting. I think we can all agree that it would be logistically, the pure solution would be just a price. But 45Q is getting the industry in gear to capture CO2. LCFS is doing the same. I noticed you said at the beginning something that really resonated with me, and that's security of offtake. The nice thing about 45Q is it's one price. It's $50. LCFS is currently $200 in California, but the price is variable. It moves all over. So when you're looking at doing a 20-year financing for a direct air capture facility or a bioenergy facility, it's very difficult to know what that price will be over time, and that's holding things back a bit.
Just pursuing this a bit more, Catherine, you were talking about disclosure and transparency and consistency and the problems of lack of consistency, which you are alluding to now. We talked about producer versus consumer getting the benefit or paying the penalty of a carbon price. So what can consistency do, and how can global cooperative strategies work to pursue this?
Well, I think the list of different mechanisms for pricing carbon that Jonathan was noting there is an indication of the extent to which there is opportunity for forum shopping, both by the producers of carbon as well as by those who want to invest in carbon solutions. And the challenge of the inconsistency in the global approach and the different prices that you get from these different approaches is that you can have, for example, a regulated financial institution clean up their balance sheet and discipline their borrowers for capital allocation towards a climate-friendly product or production method. But then the dirty stuff just goes into another venue, to another type of financer, another type of institution that is not regulated, that is not party to total climate finance disclosure. And the end result, of course, is that you get a clean balance sheet, but you end up with the same amount of carbon. So the forum shopping, I think, is a very important problem. Of course, to some extent, the commitments that were made under the Paris Agreement at least created an avenue towards which countries were trying to get to a specific commitment to doing something with their outcome, which was the collective outcome of carbon emissions. And again, forum shopping against a commitment that countries make is a little bit more difficult to do, because at least everybody's made a commitment. So that's one of the problems with lack of consistency, both across methods as well as internationally. But in terms of transparency and disclosure, again, the question here is kind of much more micro, as in what's green, what's not, and how should we treat that when we try to do these cleaning up your balance sheet or lending to green projects or being a borrower who is issuing quote, green debt. I mean, if nobody really knows what the taxonomy is, and I'm using that word because of course that's the European Union approach, is the taxonomy. If we don't all agree what the taxonomy is, then again, you get some interesting ways of arbitraging across these different strategies of transparency and disclosure, which may be very attractive from the standpoint of financiers, because you can gain alpha from that. But you know, again, creates challenges for the development of the financial approaches to this marketplace.
Yeah, and so you're pleading in a way for a clearer definition of green finance.
Yeah.
You know, see, how do you feel about it? What are the benefits of a broader definition of clean finance than the one that Catherine's pointing to? And you know, I hope we don't get into fisticuffs with one another over this issue, but I'd like to bring out what the benefits might be of a broader definition.
Yeah, it's interesting what Catherine says. I think that you can see pros and cons. I think that the fact that there has been the ability to do financing based on various green metrics and sustainability metrics, which are still, you know, relatively undefined or sort of voluntarily defined, has brought a lot of interest to the market. We're seeing corporates start to report on carbon emissions that they previously hadn't reported. Maybe they're not reporting in the same way across the board, but they are reporting. They're putting in ways to measure this. And so I think it's been a really attractive way, including now with price incentives, right? You can get cheaper debt, maybe just a little bit, but cheaper debt by doing it based on these KPIs. It has brought a lot more entities to this market and to incentivize them to do it. Now, ultimately, yes, at some stage we need to compare apples to apples, and there is this move. Catherine mentioned the taxonomy in Europe that is moving towards this. There are delays in implementing that, as many probably know, partly because there is difficulty in agreeing to things like, you know, nuclear and gas, and you know, how do we think about those in this context? In the U.S., there's a big push for the SEC to implement some standards, but again, you know, there are a lot of different players pulling at this from different directions. So we're not, even if there is a taxonomy in Europe, we're not likely to have exactly the same in the US, but it is clear that there is a push towards some form of standardization that will be helpful in for comparison purposes. And there may still be certain things around the edges that are unclear, but I think we're seeing everyone move into that direction. The one thing I would point out, though, is you know, there's a big disclosure issue for companies in the US that are public reporting companies that provide this information and are held to securities liability standards based on them. So it is an area to be careful about what you say. There's one thing about marketing and, you know, having KPIs for debt, and there's another thing about making public disclosure documents that you are held to into the future. So there's sort of a tightrope to walk here that we'll see a lot of people going down in coming years.
Right. I'd like to pursue a little bit of a conundrum, I think, in the conversation. And I do it, one of the things I did when I was younger was write a book called The Politics of Economic Interdependence, where we noticed the way countries could, in an interdependent world, push the burden of adjustment onto other countries as they would want. Recently, like now, we have the largest polluting country in the world in East Asia, the largest steel maker in the world in East Asia, deciding to put a lid on its steel making in order to reduce its carbon footprint by using less met coal and other things that go along with it. So it has a quota on itself, self-imposed, but it's in a world where others take advantage of that. So that big country can drop its carbon footprint a little bit, but it's shifted onto the rest of the world. So net, there's zero gain. Is there other kinds of examples that one ought to be aware of, Catherine and John, on this issue related to the interdependence of countries as they try to reduce their carbon footprints?
Well, the point that I would bring forth on that is, as I say, the Paris Agreement did put out commitments by countries to achieve certain carbon goals. And one can argue those were not tight enough. They should be a little bit tighter, 1.5 instead of 2 degrees. And if those commitments could increasingly be tightened, then it becomes increasingly difficult to have the kind of spillovers from one country to another that you're suggesting. So that's the first point. The second point, which I think is an interesting strategy that is under consideration, of course, is the carbon border adjustment mechanism, which is to incorporate the carbon footprint of cross-border trade. And it's kind of controversial. It's kind of questionable whether that would be legal under the WTO, because in the past, production method has not been a means by which you can put a dumping duty or put a tariff on a product. But nevertheless, if there could be a breakthrough so that we could look at carbon border adjustment mechanisms, then again, you get to the place where it is more difficult for countries to foist onto their, or it's not countries foisting onto their neighbors. It's private sector opportunities that are to move the dirty industry into a less stringent environment, pollution environment. So it's not like, it's happening by magic that that the pollution is moving, the carbon is moving to another country. It's because, private sector firms realize the opportunity of taking their polluting industry into another country with a less stringent environment and doing their business there. So it comes back to the private sector incentives and how the range of approaches to pollution, carbon are addressed in a global context.
John, do you have any words on that, or can I ask you a different question?
No, move on. Great.
Yeah, so you have in your company, on your advisory board, some of the most prominent scientific advisors that one can imagine, people who have unrivaled expertise in direct carbon capture and other things. What sectors and technologies do you think need more attention when looking at a decarbonization portfolio?
Yeah, I mean, so I guess, unfortunately, when you're looking at the size and scale of what's needed for broad carbon management, which I think the lower bounds will be something like 10 gigatons per year, which is twice the size of the oil and gas industry volumetrically, very much an all the above approach is going to be needed. I might even start more with like first principles, that when we support, whether it's a corporate private market goal or public policy, and this is kind of why we started the firm with a sort of science first approach. I think that we need more work just on full life cycle accounting of policies that we're supporting, corporate goals that we're supporting across a range of things, whether it's in reforestation, whether it's in direct air capture, whether it's in carbon conversion, whether it's in sustainable aviation fuels. Because some of the things that we found is that we're often paying for, either through the treasury or through corporate coffers, very inefficient prices per ton of carbon removed, avoided, or abated. So that's kind of the core of our work, is really looking at what the actual cost is in dollars per ton. And we need significantly more of this. I mean, you're talking a CCUS industry that had $100 million invested in 2019 and needs to scale into the gigaton range. And then on reforestation and afforestation, yes, there's financing, but it's also been very inefficient on a per ton of carbon basis. So regrettably, it's a cross-disciplinary scale that needs to happen.
Yeah, I'd like to turn to the three of you in looking at recent events. Those recent events are a couple of years worth of forest fires in California, and a once in a century event that happened twice in a decade in Texas with the freeze off. So how can firms and public policy best address the challenges that are being brought about by the higher frequency and the higher severity of weather events? And whoever wants to lead off, fine. Catherine.
Well, I mean, the insurance companies, in some sense, have an important role to play here, right? Because ultimately, these weather events, and the insurance companies have been looking at weather events for quite some time. And the question is, does public policy work in conjunction with private insurance such that private insurance can actually charge for the policies that should be put into place associated with weather events? Think about flooding from hurricanes, for example. And what you certainly don't want to do is have public policy stand in opposition, which is, we will make everybody whole when there's a weather event. We won't do that as public policy. But insurance companies, of course, are already doing this. So that's the first thing. Then the second thing is going back to the role of the central banks and regulators is the use of stress testing and or scenario testing. It's a little unclear exactly how the central banks want to treat a weather event, but to incorporate climate and stress testing, scenario testing directly into their regulatory review of the system-wide and systemic implications of climate for the financial sector as a whole. Because of course that's kind of what their job is to do, is to look at systemic risks to the financial sector as a whole and to stress test or scenario test. And we can talk about what the difference are between that, but and that's the role that the central bank and regulatory community can play.
John, you want to make any comments on that?
No, I thought that was a
okay. Well, let me ask you a question about it then, directly related to what's recently happened in Texas, and that is we have a state that's rich in hydrocarbons and a state that's rich in wind power, and it was not rich in storage of one sort or another, not rich in other regulations, but there was a storage gap. Storage was available for 8 hours or 12 hours, and here we have weather interruptions both in Florida. Excuse me, in Florida's where I am, so it was on my mind in part because I was thinking what Catherine was saying, and here to get weather insurance on a hurricane for wind, you must have either windows that are hurricane proof or shutters that are hurricane proof, at least up to 200 miles an hour of winds. But what role should we be looking at in terms of the right kind of fuel to be there in an emergency and battery power in general? Do you have any observations on that, John?
I'm not sure that I have a specific. I mean, Texas was an instance where both renewable and traditional fossil energy had significant shortage and issues. I mean, I think for me, and because we're more focused on the sort of carbon management side, the story of that is just how much more we're going to need in total CO2 management overall, because we're very far away from figuring out intermittency and storage issues. We're making great strides. There's been battery cost declines, but when you look at the total storage amounts that are needed globally for, we do a lot of work with individual utilities that if you look at their storage requirements to prevent from intermittency, just on one utility in the US, it's 5x the total US capacity today. It's just not there. So what that tells me, with a little bit of a different focus, is just how much overall CO2 management is going to be needed by 2050, because we're going to continue to have high ranges of emissions because we're not going to be able to hit those goals. That's a bigger message to me than the specific battery technology that could solve things or a different energy mix that could help.
Well, in 3 or 4 minutes, we're going to turn this over to questions that are coming in from people who have participating in this, listening to us. But before we get there, Enosi, can you kind of share with us your views on challenges that need to be overcome to jumpstart meaningful securitization of packaged loans in the power sector or other sectors? And are there areas in which there should be specific investor concerns on risk?
Yeah, sure. Securitization is not new, and it's been used in the energy sector for stranded assets, for nuclear stranded assets. It's actually talk now of having it used for retiring coal plants that are not economic anymore, and using those funds to be redeployed for renewable project development. And so I think this is something that can be rolled out in the renewable new energy space. There is a scale issue, right? Securitization works better when there are portfolios of assets that are brought together, and we're seeing some of this happen, right? Solar projects, wind projects coming together to form that larger pool of revenues that can be used to securitize. So I think we'll face the same issues as we do in any other securitization. Is there a stable revenue stream that can be used to support this? But the features are there to be able to have this, strong securitization products come out of the renewable space, the traditional renewable space. And then, it depends on what happens with the new energy space, but that at some point will generate the revenue streams that could be securitized.
Great. Catherine, John, any observations on securitization before we turn it back to Kevin and Bill Squadron?
My only comment about securitization is that for a very long time, there's sort of been this, long-term assets with long-term liabilities, that there's all these pension funds which have very long-term liabilities. And of course, they're going to want to have long-lived assets, as Enosi said at the beginning. These are very long-lived assets. The key is just because you have a long-lived liability doesn't mean you want an illiquid long-term asset. So the issue about liquidity of a securitized asset, I think, is a very important one in order to unlock some of this long-term liability money that ostensibly should be perfectly well married to the long-term assets.
Good. So,
Excellent.
Bill, Kevin? Yeah.
This is Kevin with Our Energy Policy. Thank you to all our panelists and Ed for moderating. We will open it up now to questions from our audience. We already have a few lined up. If you do have a question for Ed and our panelists, please feel free to type it into the questions chat on the right-hand side of your screen right now. Question for the four of you from Jeffrey Perry. What do you see as the prospect for merchant financing of clean energy projects, especially those with tax equity participation?
Should I jump in on that? Just from a traditional bankability perspective, it raises some challenges. We've seen some merchant financing happen with traditional power projects, but even that took a while. And so with new energy, I think a lot will depend on the overall structure and the extent of the fiscal support. And if we're talking about an OREC contract for offshore wind projects, where a substantial amount of the revenues are supported by that renewable energy contract, then there could be a portion of merchant revenue that comes in and flexibility to do that. If that's not present, then there will be more challenges. So I think it very much depends on the type of structure. But in general, the newer and more risky the project is, the harder it is to be able to rely on merchant revenues to do a financing, particularly with a traditional commercial bank project finance debt sources.
Great, thank you for that, Enosi.
I would note that kind of problem is even more extreme in emerging markets, where in addition to some uncertainties with regard to the longevity of policy and stability of it, many of the projects are much too big for the local bond markets, for example, and so have to be financed in a non-local currency. And so on top of everything else, you also have foreign currency risk, very long-lived foreign currency risk.
Perfect, thank you. Next question is from Carl Perez. What are your perspectives on including nuclear energy in the green taxonomy? Only several states in the US have used zero emission credits for currently operating nuclear power plants.
It's a tough question.
Tough
I
question.
think that, well, it is. I mean, we've talked about it already and noted. I mean, she was noting that the the inclusion of nuclear as well as gas in the EU taxonomy is a challenge even within the European Union, and so it's an issue that does have a very an important political basis as well as consumer basis concern as well. So there is no, I mean, it's going to be very hard to get to yes or no for something like that approach to clean energy.
Yeah, I think there are a number of projects actually at work right now with companies trying to make green hydrogen using nuclear energy as a source, and that works kind of well when there's existing nuclear power. The long-term issue is, of course, a very simple one when you boil it down to the fact that it's a very expensive thing to do in the short run, and that boards of directors of companies that are in the power generating business just do not want to accept the liabilities associated with this huge investment with upfront spending, not knowing whether the 50-year life cycle is going to be allowed to pay them back.
Okay. Next question here is from Gary Krellenstein. How important has the PTC been in getting new wind and solar projects financed in the U.S.? Do you think a modified version of it could be used to assist development of carbon capture tech, batteries, and the continued operation of nuclear power plants?
I think it has been important for traditional wind and solar projects. The question is how usable is it, and how available will tax equity be as we ramp up? If you're talking about the billions of dollars that are needed for the new technology projects, do we have enough players who can absorb those tax credits to be able to provide the financing? Is going to be an open question. And so is it the PTC or is it something different that can open up the tap to more usability of the tax incentives going forward? I think will be a key question.
Great. And sort of a follow-up question we had to that one. This is from Tim Kaminsky. What are your thoughts on the probability of an investment tax credit for storage in this Congress?
R&D certainly could go underneath the rubric of basic research, which is often financed through a tax credit.
Okay, we'll move on to the next question unless there's any other thoughts there. This is from Michael Fluss.
Yeah, I'll make some other thoughts. I mean, we're in the middle. It's not even the middle. We're at the beginning of trying to flesh out a national policy in the U.S. This is Earth Day or Earth Week, and there are a lot of proposals around on the subject. And included at the fringes of what's happening in Congress are a number of areas in which changes in the tax code to give a credit are being discussed. There's something of that in what John was talking about earlier on 45Q of the tax code and changes that may come about again in it, extending it and in terms of time and extending it in terms of what it can be used for. There are some other tax codes that are being considered in terms of clean buildings that are part of, at the fringe at least, of what's being discussed in Washington. Let's see what happens with the proposals coming up this week and with the president's meetings that are also coming up at the end of this month. So I think we're going to find, some more that's not yet been put on the table, and we don't know what the final outlook is going to be.
Perfect, thank you. Question here from Michael Fluss. What responsibility do financiers have to assure that what they invest in, that the projects they invest in make technological sense and that the generator is reliable and cost effective?
I guess from a regulator perspective, perhaps I'll leave that to Catherine and others to address. Just from a general financing perspective, we see financiers very focused on that, right? They're looking for assurance that the returns that are presented by the developer are available. And this is both on the debt and the equity side. The debt side tends to be more conservative, and they will scrutinize all of that. And certain risks will be allocated to the equity, and it depends on whether the equity holders are prepared to take that. So from my perspective, kind of doing transactions, it's not so much, you know, what their responsibility is, it's sort of what they're prepared to bear in terms of risks vis-a-vis new technology. And if it's too risky or too new, then there will be less appetite from financing sources to get into that area.
The only thing I would add is that I think this is one area where you do need some additional policy support, because as you know, as you said, you know, the investor is going to need either technological comfort or pricing the technological risk in some way, whether it's equity or debt. First of a kind projects are difficult, so there's more risk associated with them. The costs are generally higher. So we see a pretty big role in helping those initial plants through securing financing, offtake agreements, and other areas to get capital markets excited.
I would have to push back a little bit on that. I mean, you know, this is what venture capital does. They take on very risky projects, and there's a lot of money to be had. And it's, you know, if we think about the size of some of and the longevity that it might take to actually get to fruition, think about pharma. Yeah. So, you know.
There's exactly zero venture capital firms that would ever provide project financing for an industrial scale carbon project, hydrogen project. That is not what venture firms do. Venture firms take early stage risk where there's equity upside potential that's significant. Project financiers look for low teens to high single digit IRRs to provide significant amounts of capital, and they are not willing to take that risk. Relying on venture capital for this won't work. There will be zero venture capital money put into project development, zero.
Yeah, and that's consistent with what we see too. I mean, you see some private equity coming into more established energy project sectors, right? We've seen private equity come into gas to LNG, but if it's completely sort of new technology, that is a challenge.
This is the whole reason.
There's a role that they have to play at the initial research phase.
Correct. At the initial research phase and at the initial capitalization, there's a big role for venture capital and other forms of capital to play. Venture capitalists do not take project finance risk ever. And this was the big challenge with Clean Tech 1.0. You had venture capitalists capitalize early stage commodity and industrial companies with no ability to provide the project finance capital that they would ultimately need. So they're very capital inefficient in terms of who was investing into those companies, and the majority of the companies failed. There were some successes, but those successes came because they were able to raise project finance capital. Other types of finance.
Yeah, but the pharma model, I think, is one that ought to be.
That is not a good model for this industry.
I think you know, we have a perfect example of the combination in the hydrogen development. So venture capital has been involved in getting electrolyzers off the ground, and in terms of you know, developing PEM membranes and early stages of thinking about how to get hydrogen out of water. But the project size of it is what we saw happening last year. Small projects or big projects. The biggest one being the Saudi NEOM venture, which is a $7.5 billion venture, trying out a technology that needs to be scaled up to see if it works. And to get it scaled up, the government effectively took a third of the risk. It took $2.5 billion of the $7.5 billion risk, and companies, a couple of companies, took the remaining risk of the investment. And it wasn't done by project finance; it was done by direct finance.
Okay. Well, next question here, unless there's any final thoughts there. Question is from Mike Lubell. Assuming the same metrics and transparency, are there significant differences in financial estimates based on a carbon tax, fee-bate, versus those associated with a cap and trade policy?
You can always make a cap and trade turn into a carbon tax. The question that I think is important, I mean, this is kind of like micro 101 type stuff, is when you have a lot of uncertainty on both the supply and the demand side, which of those two mechanisms represents a better way of communicating incentives to private enterprise and to private consumers? So that's something that requires a fair degree of understanding of both the uncertainties on supply and uncertainties on demand, and then you're getting into scenario building. So before you get to that point, I think what you're going to end up with is political second bests, the things that you could get through a political system and legislation and common approaches internationally. And is that going to, I think that's where you will end up answering the question, as opposed to answering the question, which one is better?
Great. Thank you for that. Next question here is from Robert Hallman. How do you maximize the effectiveness of financing tools at the U.S. Department of Energy that bridge the gap between pilot stage and commercial stage development of new technologies?
Yeah, I'm not sure I understand tangibly what that question means.
Okay, we do have a follow-up question, similar, a little bit more targeted. The DOE currently has a $40 billion loan guarantee program. What recommendations would you have to get the program more fully leveraged to finance CCS, storage, and non-carbon based energy sources?
Well, I mean, there is work going on, right? I mean, there's been some innovation funding for new direct air capture. The Department of Energy is doing some good work paying for engineering studies, feed studies, things like that to actually help some projects get off the ground. We need more of those, but I do think that there's been an increase in the administration, and they have a good roadmap for what needs to be accomplished. It just needs some speed.
Great, thank you. Another question from Robert Fishman. Is there an appetite for long-term financing of, say, 30 to 40 years for whole building net zero energy retrofits at scale? Do you see a need for federal support for this, and what instruments would be needed? Example is PACE or HUD mortgages.
Yeah, I think it depends. It depends on the area and the assets. There are funds, infrastructure funds, insurance companies that are looking for these really long instruments that they can invest in. And if it's structured right and it provides this long-term cash flow stream that can be relied upon over time based on the underlying project, and I think that will have private capital attracted to it. In terms of government sources, I think that's also a potential source. It depends a little bit on how, again, if it's sort of risky enough that you need to use the government source versus a private source, then there may be more difficulties in putting that in place. But there's definitely appetite for long-lived assets that are basically throwing off revenues over a long period of time to support these funds that are developing, that are looking for those assets to invest in.
Thank you, Inosi. I've had a couple questions come in. I think all of you could probably speak to this. Summarized by the question from Margaret Jamson. Curious for your thoughts about how regulatory risk is viewed by project financiers.
Well, maybe I could start. It goes back to the point I made. Is there a clear regime? Is it stable and understandable? So not sort of changing its mind depending on the administration. And is it there? Is it durable for the long term? And so, we've seen this in the LNG sector that we were very involved in. It's sort of a good example. LNG came from zero exports in the U.S. zero in the U.S. to U.S. being the third largest exporter worldwide. And some of the concerns initially were the export permit that had to be issued by the DOE. Was it available? Could it be revoked? And a lot of time and money was spent trying to understand that. Now, the clarity that was provided by the DOE over time, it came sort of in fits and starts, but it came over time, that those permits were there for the long term, was very supportive in growing this industry. I think that we're seeing the same in offshore wind with the Bureau of Ocean Energy Management. Like, when do they issue the EIS? Or what are the standards? What will they take into account? You know, what is the process and timeline? The more certainty there is in that, the more comfort that the pipeline has that there will be consideration on metrics that are understood and that investors can then provide capital to support.
Okay, looks like we have time for one more question here. What would you say is the best way to make transparent and comparable data available to businesses and investors for their financial decisions?
Coming up with a set of standards.
Set of standards.
I mean, I think, you know, there is a tension between having a set of disclosure rules which are identical across all jurisdictions and really and being appreciative of the degree to which the environment is changing, meaning literally the environment is changing, and so the risks are changing and what you need to disclose is changing. And so you don't want the disclosure standards to be so rigid and unchanging that you're measuring something extremely well, but it's kind of like missing the forest for the trees. So there's a tension.
Yeah, and the SEC and various other organizations that are looking at this are focusing on materiality. What's material for your business? Report on that. I mean, some standardization will be important, but looking at it from the general lens of what's material to business as the world gets more comfortable with these metrics, right? Understanding how they're put together and calculated will be something we're probably going to see more of in coming years.
So I hate to jump in here, but unfortunately, while we could go on for a long time and a lot of questions, we got to as many as we could, but we do promise people to be punctual, and we're really grateful to all of you, Ed and OC, Jonathan, Catherine, for that insightful, fascinating discussion about a topic that's of such importance and so timely right now, as we have a new administration, we have the economy going through the transition out of the pandemic, and we're very grateful to you for the time. I do want to thank our co-host Citi. I want to thank BP, which is the underwriter for this series. I also want to thank our audience for taking the time to join us today and encourage you to take advantage of various programs on the OEP site, including the OEP library, where, as I mentioned earlier, you can find the recent Citi report on financing a greener planet, as well as all kinds of other resources on this topic. So thank you again for your time today. Thanks to our panelists and moderator, and please be on the lookout for our next webinar coming up in a couple of weeks. Have a good day, stay safe, and thanks to everyone.